Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Fears around China's AI progress spark a deep tech sell-off on Wall Street. Nvidia loses $589 billion in market value, the biggest one-day drop in US stock market history. OpenAI Sam Altman praises China's DeepSeek as impressive, but says the company will deliver better AI models. Plus, President Trump says he wants across-the-board tariffs that are much bigger than 2.5%, and he'll soon add tariffs to semiconductors, pharmaceuticals, and some metals.
In the meantime, a quick check on these markets. Is it fair to say, relative to yesterday, seeing a little bit more optimism in the markets? Although futures, they are flat, higher by only 0.1%, but still not selling off in day two of that, maybe pairing some of those losses. We'll see if that continues into the open. The 10-year at 4.55 feels like the theme for today is paring back yesterday's trade. Same story with the dollar, higher by 0.4%, stronger against all the G10 currencies. And of course, copper, as Anna was talking about that tariff story and commodity impact, already seeing LME 3-month contracts really pricing that in down by 0.6%. The countdown to the opening trade starts right now.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser focused on competing to win.
President Trump speaking yesterday after the DeepSeek news caused such turmoil in the markets. Big drop yesterday in names like Nvidia. We've already outlined the details. You were watching the coverage yesterday. The question Tuesday morning is, do you buy the dip, Chrissy?
I mean, not yet, based on futures,
Nope.
right? You're not seeing that exact excitement. I thought it was interesting, though, because suddenly maybe you should be buying them. The premium has completely collapsed with some of these names. You look at the Nvidia premium, for example. We'll get the chart up for you in a little bit. But, like, it's just, it makes the incentive to buy quite good. And yet, no one's buying. I wonder what the hesitation is.
It seems they might be buying some of the European names that were sold off yesterday. Certainly seeing some suggestions that some of those energy companies that were thrown out for good reason yesterday, associated very much with data center stories, but some of those maybe have sold off too much, and we might see some gains there. Interesting that some of the things we talked about yesterday carried on throughout the day. People asking questions about, the costs look incredible for DeepSeek. Are they really what they seem to be? But people adding other concerns in there. Security was one that seemed to come out through the US day a little bit more. What is going to be the incentive or lack of incentive for US businesses to get involved with a company where your search history essentially might end up in Chinese hands?
It does seem as if we don't, to your point, we don't have enough information yet. And maybe that's the point about buying the dip. Do we know yet enough about what is happening here to fully understand the implications of it? Has the game changed? We don't know yet, seems to be the answer. We didn't know the answer yesterday. I'm not entirely sure we know the answer this morning either. So maybe the caution is warranted until further details begin to come out. And it's going to be interesting. We've obviously got to work our way also through the reporting season. Microsoft is out this week. Meta's already kind of pre-announced its story. We've got to wait a few weeks until we get Nvidia. So maybe the market just wants to wait until we start to see some numbers coming out.
Yeah, it will be
from some of
fascinating.
these big tech companies.
Fascinating to see what these big US companies have to say. What's their appraisal of DeepSeek? We've got a little bit of that already, haven't we? But through the earnings story, we will need to get more detail of what they think that the rivalry is or the benefit of DeepSeek in their markets.
Yeah, it's interesting. I mean, it's just all that surprising, though, because it is simply only one company who's broken through yet and only done it at a fraction of the cost. There's still insatiable demand for these kind of products, and you've seen this idea from several of the industry players kind of saying, look, this is positive, but maybe not as big of a deal as the markets are making it.
Yeah, a couple of really interesting positive trends coming out yesterday. The fact that Meta went higher in yesterday's session. Apple was flat by the end of the day. Edward Harrison on the Markets Live blog quoting the Gerrans paradox. I was not familiar with this economist of the 1860s, but basically suggesting when something becomes more productive, you can see more demand for it. And this was a question raised by Richard Windsor yesterday, saying, actually, we don't know how this is all going to develop. Is it going to turn into a positive for businesses that employ this kind of technology? Not necessarily the ones. But you see some of them on the screen on the right, certainly Jensen Huang, who supply the chips for it.
Do we get back to the Cisco argument, which is Cisco was the story of the 2000s. We kind of built up to it. Cisco was kind of where the value lay. And yet, when the dot-com bubble burst, we understood that it was not where the value lay. The value lay in companies utilising the technology rather than building the technology. And that comes back to the Nvidia argument. Is Nvidia ultimately going to be the winner out of this, or will other companies, other businesses, other sectors that haven't even yet been possibly impacted by AI, is that where the effect is going to be felt? Like you think about kind of Amazon and the kind of big companies that came out of 2000.
Yeah, well, it was interesting that if you look at kind of the biggest market weights in the S&P 500 yesterday, obviously it was Nvidia, obviously it was Broadcom, then it was Microsoft and Google, and that's a cloud story because what they're trying to do is not only still bring everyone up onto the cloud. They haven't fully done that, even though it's been like 10 years in the making. They're trying to also add AI into that as well. And I think that's going to be a topic that comes up in, say, the SAP conversation we're due to have today as well, where we see what that integration story looks like. If it gets too expensive, does that timeline get delayed even further?
Yes, and that's certainly relevant to the SAP conversation. Just interesting, we've been flashing up the comments that we've had from the likes of OpenAI and Nvidia, and we played President Trump's response. Certainly we welcome the competition, and we're going to be resilient to this new challenge. Seems to be the message coming through, at least in the early stages, from US big tech.
The commonality between those comments is that we can do it better. We can do it better. We're going to make it faster. The question is, does doing it better rely on better, more expensive chips that require huge amounts of investment? And I think that's the question that I think maybe we still don't know the answer to there either. In terms of other things that are happening, I think it's just worth bearing in mind that we've got the Fed meeting coming up. I think the meeting starts today. That's going to be something that I think we will probably end up paying quite a lot of attention to by the end of the week. Besant got confirmed yesterday, which I think is interesting as Treasury Secretary. But a little bit of tension between Besant, you could argue, and President Trump. So Trump's moved the dollar this morning quite significantly with his comments about he wants more than 2.5% as a universal tariff. Now, the reason why he's saying that is because he was asked a question about what Besant thought. Besant apparently wants to gradually increase, starting at 2.5 and go from there. Trump's out basically saying, no, we're going to start higher than that. We're definitely going to start higher than that. So a little bit of tension there, maybe between the White House and the Treasury Department.
You feel this is all very work in progress, isn't it, Cathie? Everything to do with tariffs, and you're kind of we're getting a little insight into how the policy is made in the Trump administration, I suppose.
Well, I think Scott Bessent is feeling the burden that Janet Yellen felt before him, is that you can go tough on China, you can go tough on the rest of the world, you can try to create this equal playing field, but then at some point it's going to haunt you and it's going to haunt the U.S. consumer. And it feels like that's the approach that Scott Bessent is trying to do. And even Donald Trump has admitted, look, this may not be smooth sailing for the American consumer. This could end up costing a lot more. I think Scott Bessent is trying to kick that can down the road.
But it doesn't matter what Bessent says. I think my takeaway from this is, do I need to listen to what Scott Bessent has to say? Honestly, because ultimately Trump is the final arbiter of all of this. He is going to be the final sort of person that determines what this number is going to look like. He's like, yeah, I don't really recognise that number. I'm pretty sure the Treasury Secretary doesn't recognise that number either. We're going to go for the higher number. So he is, it all comes down to Trump.
It does all come down to Trump. And interesting to see from a European perspective, as you flagged earlier, Cathie, some of the sectors that could be in focus as a result of this. Trump was sort of sector checking semiconductors, pharmaceuticals, steel, copper, aluminium. All of these could be in focus. Yes, not oil. All of these could be in focus when it comes to European stocks.
And some of the automakers as well, already kind of revisiting the idea that 25% is
for Canada and Mexico.
For Canada and Mexico, which we know the last time those headlines crossed, a lot of the European car makers got hit the most.
Well, because they produce in those countries and export an awful lot of cars into the United States. Talking of the commodities trade, we're going to get some analysis on that very shortly. Nadia Martin-Vigan, Stella Capital, oil and gas expert, joining us to talk us through what we should expect, what's happening with the oil price. Will it go down? Will it allow inflation to drop in the United States? We're going to be returning to the tech theme on and on and on throughout the show. Christian Klein, SAP's CEO. We've just seen Q4 numbers dropping. The cloud numbers look good. We'll get his take on that. John O'Toole, Mundi's global head of multi-asset solutions, joining us on the tech sell-off. And a little later on the programme, we are going to be joined by Cathie Wood, ARK Invest's CEO. Is she going to be buying the dip?
A perfect time to have that conversation. Plenty of data to watch as well today at 9:30 a.m. time. We're about 2.5 hours from that. We're going to get comments from the Bank of France governor speaking at a finance conference in Paris. We'll see what he has to say. I believe we also are on watch for the budget going into maybe not this week, but next week I believe, as well. We have some data in the States, 1:30 p.m. time, U.S. durable goods orders, and that consumer confidence story at 3 p.m. Well, it's interesting that in the tariff conversation post-election, will some of the confidence of the U.S. consumer be shaken or maybe amplified. That'll be some interesting data points as well. And then it's earnings on both sides of the Atlantic. LVMH and Boeing both coming out with some numbers.
Boeing's already pre-released. We've already had an indication of what is happening there. LVMH, yeah, after the close today. That's going to be an interesting one.
Yeah, it will be, because they have such exposure to the US. And, you know, I keep having to reset my instinct that luxury story is a China story. It's increasingly been a US story of late, hasn't it? With Richemont and Burberry, they have more positive things to say about the US. So I'm intrigued with LVMH. You know, of course, there's tariff risk on these kinds of businesses. But on the other hand, a roaring US economy.
Is there crypto risk?
Yes,
is there
with
tech
crypto
risk?
money to buy luxury items.
Apparently, bling is back. So
that's what Andrea Felster tells us.
The crypto trade is going to push that. So buy your brands. Seems to be the message. Let's talk a little bit about what is happening elsewhere and running through some details. Talking of LVMH, we've had news overnight that it is selling the stake it owns in Stella McCartney back to the brand's founder. This, as the luxury group looks to streamline its portfolio amid a global downturn in demand. Not in the United States, but a global downturn. McCartney will repurchase the minority stake after a collaboration of more than 5 years. LVMH, as we've just indicated, will publish Q4 numbers after the close today. Usually comes at about sort of 4:45. Keir Starmer and Rachel Reeves will outline later today plans to unlock roughly £160 billion worth of pension surpluses designed to help drive UK economic growth. That's the plan. Under the plan, restrictions on how the surpluses are employed will be eased, allowing funds to invest in a wider range of assets. These surpluses have increased substantially over recent years as bond yields have risen. And the Prime Minister and the Chancellor will be hosting a roundtable meeting in the City of London later today to discuss the plan and their growth strategy. So look for news on that a little bit later on. President Donald Trump says Microsoft is in talks to buy the US arm of TikTok. Other bidders so far include the AI startup Perplexity and the billionaire Frank McCourt. Microsoft and Oracle, remember, were in the running to buy the app back in 2020 when Donald Trump first pressurized the Chinese owner ByteDance to sell the business or face a ban. This seems to be dragging on. The expectation was that this would take a little amount of time because basically we've got this kind of court story overhanging what is happening here. But the details still seem very vague about how it's going to work, who's going to own what, will you be buying the algorithm, will the Chinese be selling it? I'm astounded that ByteDance is as quiet as it is in terms of its side of the fence on this one. Well, I just don't know.
And even Microsoft not commenting, which I think is quite funny when President Trump is saying that they're in the running. Yeah. I mean, these were names we knew about before. Perplexity AI we knew about. We knew about the former owner of the Dodgers team. You know, we've had all these names in the mix for quite a while, and we don't seem to be getting to a resolution.
Well, I think Microsoft is an interesting one because even though they did have that bid in 2020, they don't own social media companies. They don't even own e-commerce companies.
Doesn't that make it easier for them to buy it?
Potentially.
From a regulatory point of view.
Totally, absolutely. But there's also a question of kind of governance there as well, because the only social media company they kind of own is LinkedIn, if you can call it a social media company. Whereas Amazon or Walmart, for example, there was a very clear e-commerce narrative in terms of being a contender for that. Also, Microsoft may buy a stake in it. The U.S. government may buy a stake in it. Yep. It's not necessarily a fully owned, cut and dry M&A deal.
What are they buying as well? The indications are from the Chinese they don't want to sell the algorithm. Can you buy TikTok without the algorithm? What's the value? How much would it cost? Where does the algorithm value go ultimately? And how do you separate? How do you come up with a number if you take the algorithm out?
And what's going to be the role of the US government in this business as well?
Yeah. And the regulation that comes with it, of course.
Yeah, absolutely. Things we will be watching on that story for sure. Now, coming up on this programme, we'll take a closer look at Siemens Energy, which has reported preliminary first quarter revenue that beat the average analyst estimate. It comes after the company's shares fell nearly 20% yesterday amid a rout in stocks exposed to AI and data centres. Plus, President Trump threatens tariffs on foreign-produced steel to compel producers to manufacture in the United States. We'll keep an eye on European miners at the start of trade. Up next, we're joined by George Maris, CIO and Head of Global Equities at Principal Asset Management. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
"42 minutes until the equity market open here in Europe. The question every portfolio manager sitting down this morning is going to be asking themselves, do I buy the dip? What's catching your eye, Cathie?
Well, kind of that exact story. And whether or not you buy the dip in Europe, whether you buy the dip in Asia, whether you buy the dip for what used to be the world's most expensive and valuable company, that, of course, is Nvidia, kind of getting dethroned by yesterday's market action. It's now Apple that is in that top seat. But I think that premium really hits the point that you were trying to make there, which is that it's actually not seeing as much of a premium relative to the S&P 500 as maybe it did before. That's the reasoning, perhaps, for creating the buying opportunity outside of the fundamentals. But is that maybe depressed premium even juicy enough to actually bring about this flood of actual buyers? I want to put this into a broader perspective, though, because Nvidia, of course, is the major weight in the S&P 500. I want to show you what it did to the broader index as a whole on a very volatile 12 months time. This little blip right here is the drop from yesterday, but I really want to point out that in the last 12 months, you've seen more pullbacks, more little mini corrections is what I'm calling it, basically pullbacks of over 5% than you have in previous years. It really highlights the fact that volatility is actually increasing, even though the VIX may not necessarily reflect it. But these red arrows, by the way, are showing these drops of 5%. The yellow ones, by the way, are showing drops of 2 to 3%. Again, it's normal to have pullbacks, but usually only 2 to 3 a year, not this many, which brings back the question of how much of the trade in the S&P 500 and in the tech space is really a momentum trade at the end of the day. And the way I think to gauge that is by comparing the likes of the NASDAQ to the likes of the crypto story, because take a look at this. Pre-pandemic, those were not correlated assets at all. You could see the volatility. Post-pandemic, it's absolutely been the same thing. We've gone from defensive to momentum. And, Guy, I wonder if that's where the next leg of gains come from.
Absolutely. We will watch very carefully. We'll get Cathie Wood's take on that crypto trade a little bit later on. Before we do that, though, George Maris, CIO and global head of equities at Principal Asset Management, joins us around the table. Good morning.
Good morning.
Let me ask that question to you that I've been putting to everybody already. Do you buy the dip? What did you make of yesterday? And is it an opportunity or a threat?
I think it's more in the threat than it is an opportunity. There's still there is a real worry of disequilibrium here. The notion that we had this unassailable growth up and to the right over the last couple of years has certainly been caught into question by an intervening technology. We don't know if there's a cheaper, more efficient way of doing things. It certainly seems like it is. The statements that are coming out certainly seem to be verifying this. And if this is the case, hundreds of billions of dollars that have been spent and allocated are now open for potentially different use. So I do think we need to understand a little bit more about where the practical applications are. But for sure, this calls into question any notion of an unassailable to the right growth that was certainly underpinning all of these stocks.
Does it call into question the money moats that many of the big hyperscalers have argued they have? They simply have the cash to be able to spend, to be able to keep out in advance of everybody else. And does it, by extension, therefore, call into question the E in Nvidia, the earnings number that spending generates for the chip company?
I think both of those things are correct. I think, first of all, one of the competitive advantages for a lot of these companies, these Mag 7 companies, these spenders, has been the cost of entry has been so significant. You needed to have huge amounts of cash to be able to spend on getting access to these chips, to the data centers, et cetera. Well, all of a sudden, if we can do this at a substantially reduced cost, that moat has been completely taken down. It has democratized the opportunity in a certain way, and I think that is both exciting and also a threat. The same notion, it calls into question what is the E with respect to Nvidia. We've certainly seen that premium that Cathie talked about a few moments ago as declining for Nvidia. That creates an opportunity unless you think the earnings are overstated. Right, and I don't mean accounting overstated. I mean, i.e., that bolus that was in there has come down a bit, and we've got a more moderate place. And I think the problem markets have is we don't know. Yeah. And so you've got this period of uncertainty that we're all trying to work through.
Yeah, and George, yesterday we sat here working our way through some of the enthusiasts for DeepSeek and those who were giving us sort of skeptical news lines and trying to pass those and work out where the truth sits. I mean, and we talked a lot about how maybe it'll take weeks, months for everyone to run tests and work out how impressive this technology is and at what cost it is really producing the results it says. But then we heard from OpenAI, Nvidia, talking about how this is excellent technology, it's a great advancement, we'll do it better, but this is a great step in the right direction. Is that confirmation enough that actually this technology is then what it purports to be?
I can't answer whether it's confirmation enough, but it's certainly evidence that it is, right? And again, the players who have the most to lose from DeepSeek are telling you this is a valid technology. And there's always an opacity when dealing with when you're dealing with a Chinese company, a non-Western. You don't know how much have they spent, what's behind this. The fact that you've got the Western players who are entrenched here telling you this is legitimate,
yeah,
I think certainly does lend to its validity.
And so it's interesting, you described those as companies with the most to lose, and it did seem to be a process the market was going through yesterday, working out who has something to lose here and who could perhaps gain, because there are many businesses that don't develop this technology, but they're going to use it. And if they can do it for a lot cheaper, that's going to turn out to be a real positive, perhaps. So are we just at the foothills of working out where those positives are?
I think it's still very early stages. We're having to think through all of the laterals out there. Again, as I mentioned earlier, what this potentially does is democratize this great technology for people to be able to implement, whether in businesses or personally, in a way they may not have been able to do economically before. And it certainly opens up a realm of possibility, but it destabilizes what all investors have thought was the case over the last few years.
Where's the geopolitical risk priced into this market, given that alongside Nvidia's praise for DeepSeek, they also said there's an export control story that we know Nvidia's been suffering from. In this market, is geopolitical risk priced in at all?
You know, it's such a great question. One of the phenomenal things about this market over the last few years is its resiliency towards risk, whether it's geopolitics, whether it's economics. Right now, I'm not sure. The geopolitical risk is all priced on Chinese equities. It's not necessarily priced on U.S. equities. You can see that in the difference between Chinese equities, the Hang Seng trading at one of the cheapest levels of any index in the world. That risk was certainly being felt on them. It was felt that the U.S. had all the cards in this, being able to create export restrictions, and that was impacting China. We just saw that may not be the case.
How much of the sell-off was less about the fear of DeepSeek and these valuations, really, that just kind of needed a minute to come back down? I feel like every time Apple hits another $1 trillion mark, the market sells off and finds a fundamental reason to. Is this, at the end of the day, less about the fundamentals and more about just letting steam out of this market?
I think it's both. So for sure, those valuations were underpinned by a great degree of enthusiasm. And that enthusiasm was underpinned, again, by a notion that things were going to be great. We had this extraordinary revolutionary technology. It was going to change the world, and it was going to cost a ton to get in. And look at all the capital moving in this place. And now everybody realizes that that may not necessarily be the case. Not that the technology isn't fantastic, but the cost of entry, the cost of being able to proceed with this may very well be different than what everybody assumed just a week ago. So I think everyone is questioning what the economics behind this are, and no one knows for certain. So there's that. But the other notion is we've all seen, even from technical levels, a lot of these stocks were extraordinarily at limits, right? They were quite expensive. Okay. There was a great degree of bullishness embedded, and this is all just a reflection.
If those stocks come down, do I hide in bonds? Yesterday we saw yields coming sharply lower. Is the trade now to get back into the bond market? Is the bond market going to provide me with a degree of safety? Or are deficit concerns and all the other issues out there going to upend that argument?
So I'm certainly concerned about deficits. I'm certainly concerned. You're seeing those issues happen globally. I'm much more inclined to put capital at use in those sectors within equities that have been left behind. Okay. So smaller cap equities, more cyclically oriented equities. Again, you've got the U.S. continuing to spend and grow. You've got China engaging in a substantial impetus to grow its economy as well. These have been areas, whether it's U.S. small cap, whether it's Chinese equities, whether it's European equities, financials, healthcare, that have all really taken a seat back. We saw earlier the S&P 500 equal weighted did well yesterday. And if we recall early in the 2000s, well, everyone remembers in 2000 the market crashing. People forget that value stocks in the U.S. actually performed brilliantly. So you can, it's not as if everybody lost money. I think the rush into the mega cap creates potentially opportunities elsewhere.
This is a longer conversation about why those value stocks actually excelled in that crisis. We don't have time for it. George Maris, CIO and Global Head of Equities at Principal Asset Management, joining us around the table this morning. Coming up, we're going to talk maybe about the subject we didn't get to hit with George. And that, of course, is more of that tariff risk. Donald Trump raising new tariff threats. Again, we'll discuss the outlook for the commodity sector next. This is Bloomberg.
Welcome back. 30 minutes until the start of trading for equities markets here in Europe. Let's have a look at the futures picture then and remind ourselves that although yesterday was negative for European stocks, we were not down anywhere like the United States. Of course, the Nasdaq was down by more than 3% yesterday. Euro Stoxx 50 was down by 0.6%, and the FTSE was flat. So this is the picture for today. We are expecting some modest movement at the start of trade. We did see some movement in bond markets yesterday. Bond markets getting a bit of a bid as the market became nervous about what we were seeing in stocks. But as Guy was saying, offsetting that perhaps concerns around the fiscal agenda in the United States. Cathie.
Certainly something we're going to be keeping a very, very close eye on. You know what we haven't talked about is the commodity space to the extent that maybe we should be talking about it. Oil, we're seeing Brent crude trading at about $77, a handle higher by 0.8%. This, of course, is we have one eye on the commodity space, also in light of the fact that Donald Trump raised the stakes on planned tariffs, not necessarily targeting the oil and gas space, but maybe targeting a little bit of everything else. And, of course, this is also as we combat the concept of Russian sanctions as well. With us now is Nadia Martin-Wiggin, Director of Stella Capital and a commodities-focused alternative investment manager. Nadia, I'll start with a big picture question here. In this era of where we're talking about this kind of volatility around tariffs, do you even want exposure to commodities right now if you're a macro investor?
Absolutely. We need commodities to move things forward. When we look at Trump's ultimate agenda, it is to make America great again. It's to build oil, gas, overall commodity resources. And what we have to remember is that relationship, especially with China, it's very commodity dependent. The way he fixes that trade balance is by selling more of those commodities to China. So when we think about tariffs as Stella Capital, we're thinking more about the tech sector and things like that, not the fundamental commodities that China needs from the U.S. and then also commodities that the U.S. needs from China.
Well, you mentioned the tech sector there. Of course, that's the big topic of the last 24 hours. Walk us through kind of the input costs here when it comes to natural gas powering some of the data centers and demand for the states as well. Where does that show up in the pricing and to what extent?
Well, so the ultimate competition is for how will you power things. And as Donald Trump said in Davos, he doesn't mind what powers these facilities. But when we think about what we view as the most reliable, quick to ramp up source of energy, natural gas really checks that box, right? Whereas nuclear power, of course, that is wonderful, but we still need to build reactors. We still, we're starting up things there.
So the energy providers, the electricity providers yesterday got hit really hard in the States, down really sharply. The utilities, I think, was the second worst performing sector in the US. Expected to bounce back. Was yesterday about a reduction? Did your sector see yesterday about a reduction in demand for energy, i.e. these AI products are going to become more efficient, you could do more with less? Or is it about the fact that you can now scale these things even more, and as a result of which actually the ultimate demand is going to be greater than we originally thought? How did the people, the traders you were talking to yesterday, see yesterday's sell-off from an energy lens perspective?
Yeah, it was more viewed as an opportunity going forward. Because when we look at the situation this year, things are already very acute when we look at Europe and where natural gas needs to go. And when we think about the build-out, we have a lot of natural gas facilities coming online in the U.S., this year and in the coming 5 years. So those are not going to be changed because all of those plans, they're only the tip of the iceberg in terms of what we need in this AI revolution. So
more energy required there. Donald Trump has also indicated that he wants to see oil prices come down. He thinks that it will drag inflation lower, it will allow the Fed to cut. Do you think he's going to get his wish? Are there more things bringing energy prices, oil prices lower than factors potentially bringing it higher?
The number one motivation right now for Saudi Arabia is a balanced market that is not volatile. So what will ultimately make them produce more oil is greater demand. And that's where it's a tricky situation because Donald Trump wants the lower oil prices so that we can then have less inflation, cut interest rates, and then ultimately raise demand. But we're not there yet right now in terms of the readiness of Saudi Arabia to increase production. So I think it's going to be a very hard sell because they do not want a big drop-off, especially when he's threatening tariffs and he's threatening sanctions. And last time, he gave the sanctions on Iran, and then he gave a 6-month reprieve to most of the buyers. So they're not going, and the Saudis ramped up, the Russians ramped up, and the American producers ramped up. So it's going to be a much tougher sell this time for Saudi Arabia. Plus, the country has other priorities as well.
So he wants Saudi Arabia to pump more. He also wants US production to increase. Does buying for the Strategic Petroleum Reserve, does that act as some kind of floor? Can he go to the US industry and say, look, we'll keep buying for this purpose, and that gives you some confidence that prices don't drop too far?
Yes, that can help, but we're talking about at max 700,000 barrels per day. And right now, given the situation in terms of the storage facilities being refurbished, it's 200,000 barrels per day. So it's not such a big floor compared to what OPEC is guaranteeing right now. But at the margin, that helps. Of course, Biden kept changing when he would buy at and at which price. So Donald Trump needs to prove that he will actually do what he says in that situation. So if he sets a floor, he has to sit.
Let's think of another situation where he might be tested on doing what he says. He was asked during Davos, if you're supplying more gas to Europe, will you be a reliable supplier? Can we rely on that? And he said, yes, of course, you know, if we say we're going to do it, then that is what we will do. So, I mean, there's a lot of pressure on Europe to buy more gas, Nadia. And then the threat of tariffs exists if they don't. So how do we interpret that for the gas market here in Europe?
Well, that the U.S. is really preparing to be this provider. And when we look at what Donald Trump is doing in terms of permitting and moving things forward, he is definitely working to build out that infrastructure to allow that to happen going forward. You know, America likes to have this strategic interest and having dependency on their natural resources. That's how they're trying to break that relationship between China and Russia right now. They'd rather that China was more dependent on the U.S. He'd rather that Europe was more dependent on the U.S. So it suits America's strategic interests to do it. Therefore, it makes more sense. He'll stick with it, even if gas prices get a bit higher, which they need to be higher. We have the Marcellus not producing at max stability right now. We had big curtailments last year, and we need to ramp that up now.
Speaking of strategic interests, talk to us a little bit about some of the kind of refined crude products that are coming out of Latin America and going into the States. This was something that we kind of had to briefly explore over the weekend with kind of the drama around potential tariffs on Colombia. The number one export from Colombia to the United States is refined crude products. But you don't just see that there. You see that in Mexico. You see that in other parts of Latin America as well. Is that the next place we have to focus on in terms of flows?
Well, what we know in the commodities market is we get the adjustments, right? So where you used to have a lot of refined products, you know, coming out of Russia, going over to Europe, Europe coming to the U.S., we then had Latin America come as a big supplier. And so this is where the shipping market will always adjust to that going forward on where these products come from. But ultimately, the last spare capacity refining in the world sits in China. And again, that's super important that they have access to crude oil to produce the products that we actually need in the U.S. and the rest of the world.
You've also got potentially Canadian 25% tariffs coming in on February the 1st.
Absolutely. A lot to digest for sure. Nadia Martin-Wiggin, director at Stella Capital, joining us this morning to give us a roundup of the oil and gas space. Coming up on the program, we're going to talk about European tech giant SAP seeing a massive boost in cloud sales, in part thanks to its AI business. We're going to speak to the CEO next about their outlook. Stick with us. This is Bloomberg.
This is the opening trade, 7:41, almost 7:42 here in London. And European futures, are they improving just a touch at the margin, expecting to go a little bit higher at the start of trade? Nasdaq futures, interestingly, up by 0.4%. Let's talk about technology. SAP's cloud sales came in slightly higher than estimates as Europe's biggest technology company won customers with new AI capabilities. The tech giant also raised its full-year revenue outlook. Tech, AI, all very thematically important this week. Let's talk to the SAP CEO, Klein, who joins us this morning. Christian, nice to see you once again here on the programme. Let me start by asking how you're driving this cloud revenue then, because it's a little better than the market was expecting. Tell us the composition of these cloud customers. Is this still very much existing customers being transferred to the cloud, or is this new customers coming to you for this service? How does that break down?
Yeah, thanks a lot. Good morning. I mean, clearly, 2024 was a record year for SAP. We exceeded all our financial goals, and of course, main driver is our cloud business. And look, I mean, we are not only Europe's largest tech company, we are also sitting at a nexus between business and technology. So this is where the value really hits the end users, hits the business modules of our customers. And we are infusing AI. We are partnering on AI infrastructure, on the large language models, but we are betting on our business data. No other tech company has more business data than SAP. And this is the winning formula, showing how customers can transform, no matter if they're in automotive, retail. We are serving customers from 25 industries and showing them how with AI they can gain more productivity and can grow their business.
Okay, and you say in your statement today that half of those cloud orders now include AI. So cloud has been a theme for a very long time. Increasingly, that is linked to your performance in AI. Christian, what are they able to do with AI in the cloud that they couldn't do before?
I mean, look, just yesterday I had a big German customer here in the headquarters, and we showed them how we can actually improve cash collection. I mean, we can actually analyze why customers are not paying fast enough or not paying. Is it a logistical issue? Is it a procurement issue? Is it a commercial issue? And then Joule, our digital assistant, is actually orchestrating that with our procurement agent, with our agent in supply chain, with our agent in finance. We have all of that data, and then we can provide recommendations on how to collect cash faster. Same use case in demand and supply, in the supply chain area, in sales, in HR. So we have many, many use cases. And to the point, 50% of our Q4 deals had AI embedded, and that is the best testament for the value of business AI at SAP.
Christian, good morning. It's Guy. The story over the last 24 hours has been about DeepSeek and the fact that it is able to drive down the cost of AI significantly. Firstly, what did you make of the news? What do you think the impact of it will be?
I mean, this is, first of all, very good news for our AI strategy. We said from day one on, we partner first on AI infrastructure and large language models. We believe this is becoming more and more commodity. And yesterday was a strong proof point for that. Where the value creation sits is actually on the business level. To understand data, large language models don't have access and don't understand business data. And SAP is bringing this together, the large language models, the unstructured content with the business data. And that is actually a very powerful formula for our customers.
Do you think the cost of AI will go up, though, or down?
Actually, when you look at it, I definitely see that there will be more scale on the infrastructure side. So yes, costs will go down. And we have not only seen that in AI. I mean, we also have seen that in our standard cloud infrastructure business. I mean, hardware is progressing, you reach more scale, and so costs will go down. Where AI costs will not go down, I mean, when you can show a CFO how to improve cash collection by a factor of 20%, or how to better predict demand and supply. I mean, this is real value. And customers are willing to pay a premium if AI can make this work.
Christian, as Cathie, let's take that in two parts and start with the infrastructure piece you talked about and just scaling up on that front. Most of that scaling up is happening in the States. It's something that the new President Donald Trump is really trying to push for. Does that affect your plans to scale up in the States? Do you see incentive to do so?
I mean, we are all in for less bureaucracy. We are all in for less regulation. This is what you need to drive innovation. And clearly, the first signs and the first executive orders are very promising. And we have big labs in the US. It's our largest market, and we will further invest. We also want to invest in Europe. But I have to say, this has to be a big wake-up call for Europe. We need innovation. And while it's not so important for us to have actually the next hardware company in Europe, but what we need is to applying AI in the industries we are strong at in Europe. And for that, we need less regulations, not 27 different AI acts. We need one. We need to really form Europe as a union. We are not a union today when it comes to AI and digitization.
Well, let's talk about where the cost squeeze may come from, wherever it is you operate in the world. And I feel like one of the big criticisms of the DeepSeek model and what's coming out there is, one, the security concerns that follow, and two, the costs involved in actually training up the AI itself. How much is that going to cost some of the technology that you're using in terms of the long-term training costs?
Look, SAP actually has a big advantage here. I mean, when you're running finance, HR, supply chain, sales, with SAP, we have the authorization module. We know exactly what the end users are allowed to see and not to see. And we are applying, this authorization, this security concept across AI. No matter if we actually connect to our own AI foundation with a ton of business data or to the large language module. So we absolutely own the security and the authorization layer. And so for us, what happened yesterday is really good news because we see infrastructure will scale, costs will go down, and while we see higher value creation at the business process level.
Christian, you say it's good news, but your investors, the investors in SAP stock, didn't think so. What do you think they're responding to when they sell SAP on that news?
I mean, yeah, yesterday, the news hit the market. I mean, when you look at, today, our results, you see that 50% of the Q4 deals had AI embedded. It's purely consumption driven. So, customers see value, they adopt AI. So I'm actually very confident that today, and not only today, in the years to come, look at our outlook, accelerated total revenue growth for many years to come. We are very confident about our business, and one key driver is, of course, AI.
Can I ask you, Christian, we've got a German election looming, of course, and in lots of parts of Europe, we're seeing people asking questions, politics asking questions about how to handle migration policy. It's a topic in the States, topic in the UK, France, in Germany. I wonder what you make of the latest policies in that regard from either the CDU in Germany or from the AfD, and what the tech sector should make of that kind of attempt to clamp down on migration, because to some degree it is a sector that has benefited from free flows of people.
Yeah, I mean, look at Germany. I mean, there's clearly a lack of IT talent. I mean, we need data scientists in our labs in Munich, in Berlin, here in Heidelberg. And so it's very important that we get, really good talents also from foreign countries, from India, from China, from, everywhere in the world. And that is key also for the future success of our economy. So this is what we need, the best talents in the IT sector. And the same is true actually for our labs in the United States. So, shutting down immigration completely would be, in my eyes, the right thing to do. And so we are really hoping for, a controlled immigration and really, attracting the best talents to come to our labs in Germany, because this is for us a strong reason to also further invest R&D in Germany.
Christian, we're going to leave it there. Thank you very much indeed. Interesting comments there to wrap things up. SAP CEO Christian Klein joining us on the Q4 numbers. Joining us now, Markets Live Executive Editor Mark Cudmore. Mark, we've just been talking about the sell-off that we saw yesterday. Obviously, it did impact SAP, but it certainly impacted names like Nvidia significantly more. What does day two look like to you? What happens today? Is it a buy the dip moment, or is this the start of something more significant?
I don't think it's a buy the dip moment, but I do think it's a consolidation or a stabilization moment while we kind of reassess. I think that the developments over the weekend are a really, really long-term turning point, and that's because we were ripe for such a turning point. We traded the previous narrative of kind of US exceptional privilege in terms of its stocks valuations for so many years. There are such stretched valuations that all it needed was a catalyst to change that. Now we've had the right catalyst come through, and that means I think that this is a really long-term turning point. However, in the very short term, we have 4 of the big US mega cap names reporting earnings this week. And these are still very, very solid companies making very good money. This is not about suddenly becoming super bearish on US tech sector. It's talking about the fact that the US tech sector has a very large valuation premium that's going to come out of the market while the rest of the world can catch up. Because what happened yesterday wasn't just a negative for US tech at the margin. It was also a positive for US productivity, a positive for US global growth. And it's value stocks around the rest of the world. It's stocks that were previously seen not getting full access to the US AI tech miracle, either because of sanctions or because of cost. It is those stocks that will now benefit. Emerging markets, value stocks, the rest of the world, even US stocks outside the tech sector that can do well.
Mark, what do you think of the latest commentary around tariffs from President Trump and the market's response, or where we're seeing it, where we're not? I mean, are we going to enter a period of kind of diminishing returns or less reaction function to what he says day in, day out? And the market may be getting to a point where it wants to see actual policy before it reacts too much?
I don't think we want to see the tariff policy, but you're right. There's diminishing marginal kind of reaction to these threats. And at some point, we need the bite to come through to follow up the bark that we're getting, the regular bark on tariffs. And people do believe it will come through at some point. I am really struggling with the tariff story. It is very clear that, tariffs announcement, the knee-jerk reaction is dollar positive. And that makes sense at the immediate basis. But all this uncertainty around the US tariff policy is ultimately a net negative for US companies. It means that US companies cannot plan reliably on their supply chains, and it means companies around the rest of the world, if they have a viable alternative to the US, they'd prefer to choose it. They prefer to choose where they can get certainty to make long-term business planning. So this is another cost to US business, which the new administration is adding, and it coming at this vulnerable time of stretched valuations, and now when they're being threatened on the kind of AI hegemony. So I think that tariffs, any kind of sudden tariffs that we're likely to get at some point, will be a dollar positive. But it's into that spike that I think you probably see the end of dollar strength and the start of subsequent dollar weakness after that.
All right, Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. We're also in the next hour have a very exciting interview. We're going to be joined by Cathie Wood, founder and CEO of ARK Invest, discuss whether now's the time to buy the dip in U.S. technology, crypto, Trump. It'll all be on the agenda.
Absolutely. We'll get her take on what yesterday actually delivers going forward from here. European equities this morning, we're 5 minutes away from the market open. Looks like we're going to see a mildly positive open.
Yeah, coming up then, we'll bring you that opening trade. Futures, as you say, Guy, pointing a little bit higher this morning. This is Tuesday, everybody. This is Bloomberg.
A few minutes ago until the opening trade here in Europe this Tuesday morning. A few things to say about yesterday. The first one is, obviously, we did see a big drop down in the States. We saw a big drop down in Europe as well. There was a gap lower first thing. Then we actually traded reasonably sideways. And actually, by the end of the session, we were starting to see maybe a more positive picture emerging. Obviously, this was from a very low base. The other thing that's worth bearing in mind is that actually the equal weights had a very good day yesterday. The rest of the market did all right. This was a tech story. So it's going to be interesting to see exactly how this progresses this Tuesday morning and what it means ultimately for European markets, which pretty pointing a little higher this morning.
Yeah, if there's an argument to buy the dip, then perhaps you're seeing the early signs of it in the futures picture. Your Stoxx 50 futures higher, marginally only by 0.2%. But the real high flyer is DAX futures. I wonder how much of that's going to be a reflection of SCP and some of the other earnings we're getting in Germany, higher by 0.4%. But even, Anna, seeing a little bit of a rebound in the Nasdaq 100 futures as well, higher by 0.4%.
Yeah, absolutely. Not at all making up for the losses of yesterday, but still interesting to see that we are putting in that bounce this morning on Nasdaq futures. Here in Europe, then, Cathie, in terms of the individual stocks in focus, Siemens Energy, it was down 20% in yesterday's session. Could we see a substantial bounce this morning? First quarter revenue beating estimates. You've still got Bank of America out there raising its price target to 83 euros, even though this is one that traded as of yesterday at 48 euros. So there's still quite a lot of optimism, it would seem, in the markets around that business. SAP in focus. We just spoke to the CEO. Cloud growth coming in better than estimates, pivoting to AI tools. That's the news flow around that business. That one was actually only down 0.8% in yesterday's session. And autos and miners in focus, along with steel, copper, aluminium, pharmaceuticals, semiconductors, all because President Trump mentioned them, Guy.
Okay, here we go. Tuesday's session is almost upon us. It is time for the opening trade. Let's take a look at some early numbers and figure out what is happening here. FTSE's probably going to be the easiest one to read first. Not exactly a clear sense of direction. I feel we get this conversation coming every day. We are going to wait, I suspect, for the German market to open. Could take a little while. Took ages yesterday to get the market going. Remember, we get LVMH after the close today. That's going to be another factor for the European session as we work our way towards the end of the day. So the Stoxx 600 up by 0.2%. The FTSE 100 up by 0.2%. We really need the rest of the blanks to be filled in around Europe. Here we go. The CAC 40 absolutely flat on the session. Airbus could be a focus as well. Some potential big orders coming through from Cathie there. IBEX is absolutely flat as a pancake. We await the DAX and we await the SMI, Chrissy.
We certainly do, but I think when you look at the initial moves from the stock 600, we're waiting again, as you point out, for some of those German names to actually hit and open. You are seeing kind of a tale of two sensational companies, perhaps, from your sensational six. ASML is your biggest index contributor to the upside. LVMH is your biggest index contributor to the downside. So, Anna, it does feel like a tale of two heavyweights.
And that's before we've had the numbers out of LVMH. We've had some sort of sidebar news flow, haven't we?
Yeah.
But we haven't had the actual numbers. They come a little bit later.
Is it a tariff story?
Yeah, maybe.
Because Trump's talking about quite significant tariffs. You could expect maybe them to be hit by
mention
that.
Luxury goods, but maybe handbags are not
Universal.
the first thing that comes to his mind. Yes, indeed. Yeah, Universal. So we do see some weakness, as you say, Critty, in some of those luxury names. LVMH is one of them, but we have others weaker. And consumer-facing businesses weaker. So Puma, Swatch, Burberry, all of those down by more than 2%, in fact. So there's some weakness across the board, it would seem, in that luxury space, consumer-facing space. But technology is the best-performing sector today, up by 0.5%. A little bit of a bounce in some of the names there.
We're certainly still watching and waiting for that initial opening trade on SAP as well. We know that they were priced in the positive direction on TradeGate, so we'll see if that shows up. I know just barely. The earnings came in barely above the consensus as well, so we'll see how that all shakes out. We'll bring you the live pricing, but I think the big question is, do you buy the dip from yesterday? Is that premium still juicy enough? John O'Toole, Global Head of Multi-Asset Solutions at Amundi, joins us around the table this morning. John, I'm going to put that question to you. Have the valuations come down enough in one day to make buying the dip worth it?
Good morning. One day is one day. We had some dramatic moves yesterday. Obviously, Nvidia down, 18, 20%. That does take it back to levels where we saw at the end of September. So, to keep things in perspective, in terms of our longer-term play, we think it's a reasonable opportunity to put risk in portfolios. We think the growth dynamic is reasonable. The disinflation dynamic is still intact. So we are on the risk-on side in our portfolios strategically. Obviously, there are some extreme valuations. The S&P at 23 times historically is not a good starting point to enter a market. And historically, returns will be so low single-digit if you enter at 23 times. Valuation adjustment, valuation doesn't move it on its own. So we've had an event. We've had this DeepSeek story, and the question is this going to metastasize into something more and more of a bigger sell-off? It doesn't seem like that, but ultimately it seems to me that if this technology, which is an enabling technology, which is going to improve productivity massively, if that ultimately becomes cheaper, net, when we look through all this, that can be a positive for growth.
So you mentioned a couple of things. You mentioned the disinflationary narrative. You mentioned positive for risk assets. Could you qualify tech as a risk asset when it traditionally feels like rallies more on a defensive bid than maybe a risk-on bid?
No, indeed. So, when we talk about risk assets, we really talk about the broader equity market, credit markets, and really, growth is slowing. And, our outlook is that growth will slow to around 2%, give or take, which is not dissimilar to the Fed expectation in 25-26. With the disinflation narrative down towards 2.5%, that means financial conditions are still quite good. Credit spreads, while tight, in a non-recessionary environment, there's a huge amount of bid for credit, and we see that. So we think financial conditions are reasonable, and that can be a decent backdrop for adding to risk. Tech, obviously, has been driven. It's a super concentrated story. So we advise our clients to diversify away from that tech concentration, the Mag 7 concentration. That's what we've been doing in our portfolios, diversifying towards equal weight S&P, diversifying towards mid-cap in the U.S., which is not as exposed to Trump, is not as exposed to the tariff story. And again, we do think that this new U.S. administration will go out of its way to ensure that U.S. growth is going to be very positive. We ask ourselves, is that a bad thing? Is that a bad thing for the rest of the world? So,
OK, let's talk about the rest of the world. It's interesting you bring up the equal weight. The equal weight did OK yesterday, so the diversification trade paid off. We were talking about this a little bit yesterday. Is it, though, if I want to diversify, is it cheaper to do it through US mid-caps, small caps, or is it actually cheaper to do it through European equities or Asian equities?
No, it's a good point. So we have diversified across the board. Europe is trading at something like 13 times. Europe is very unloved. Sentiment is super weak. Sentiment is super weak around the European economy. Weak industrial productivity, weak labour productivity. The Draghi report about Europe having to really restructure itself meaningfully. So Europe is a pretty beaten-up place. There's still some fantastic companies in Europe. They're suffering vis-a-vis US-listed companies just because they're listed in Europe. So at 13 times, That's an attractive entry point. So we have allocated capital to Europe, to Japan, to the UK on that basis through the back end of last year. And again, to diversify away from this US exceptionalism story.
But is it tough to take money out of the States?
Yes.
This is the problem, isn't it, that a lot of portfolio managers face?
Yes. So again, another way to mitigate the risk in our portfolios, volatility was quite low, the VIX, so hedging was a reasonable thing to do around Christmas time. So in the close into the year
so you bought hedges into Christmas.
Bought some protection on a 3 and 6 month basis, and again that allows you to stay invested, and you pay premiums on some protection, and you can still participate in the upside.
So what does that mean, John, for your European exposure? You were saying there, Europe is unloved. Where is that negative sentiment overdone? Where do you see that we are due a bounce back for Europe? Or is it just the overall market?
Overall, European growth level is pretty anemic, in and around 1%. Now, underneath that, there are countries like Spain that are growing at 3+, countries like Germany that are basically
not growing.
And France, Italy, around about 1%. But there are stories, there are strong companies at index level, again at 13 times. From a strategic investment perspective, a longer-term investor, it's a very sensible thing to diversify your equity risk in a portfolio into cheaper countries.
Does there need to be a catalyst? Do we need to see another catalyst for Europe? I mean, we started to see this earlier this month, didn't we? Some broadening into Europe. Yesterday changed the thinking a little bit, but what do we need to see?
The China growth story is a very important driver of what happens in Europe. You will have the MPC in March in China. We do believe that the fiscal impetus from the Chinese authorities will continue, and they will try and put a bottom under the Chinese growth story. That can be a catalyst. And again, we think that that's in the background, and China is going to have to protect itself from what's happening in the rest of the world, tariffs, etc. So that can be a positive catalyst. Structurally, the German election could result in a release of the debt brake. So there are a few events out there that could be possible. We think the ECB is still on a rate-cutting trajectory. We think about 4 more cuts. So, again, that all provides a positive backdrop for risk-taking.
Why do you need growth in Europe to invest in European assets if the exposure is mostly in the States and in China?
Sorry, second?
I was going to say, why do you need growth in Europe to invest in European assets, given the exposure is everywhere else?
Yeah, Europe is between these two enormous trading blocks. The growth trajectory in Europe, we think, is increasing. It will improve. So
why Europe's been cheap for ages?
Yes.
Why now? What is it that now is it simply because the US is now too expensive and therefore you want to diversify?
It's a diversification trade away from the US. So if the US exceptionalism story via the Mag 7 is somewhat at risk, and it's had a fantastic run. You've had 2 years of double-digit return. It doesn't often happen that you get a third.
But you don't fundamentally believe... It's not a fundamental belief in Europe. Europe's getting better. It's just, I need to diversify away from there and this is cheap.
As a multi-asset investor, so running multi-asset portfolios, we're in the risk diversification business, so it makes sense to do that. On an outright basis, obviously, we have stock pickers running portfolios. They will always be risk on in Europe. And their risk stance, they think Europe is very attractive and very appealing, actually.
Right now. Cool. Great to see you, John. Thanks for stopping by to see us. Greatly appreciated. John O'Toole, Global Head of Multi-Asset Solutions, joining us from Amundi. Let's talk about some of the stocks that are on the move here in Europe this morning. We've already mentioned what is happening maybe with the luxury sector. Remember, LVMH reports a little bit later on today. We're going to get that after the bell. It is, though, lower, down by around 0.5%. You do, interestingly enough, see a little bit of a bounce back in ASML. But you go to your Bloomberg terminal, take a look at the 2-day charts, 3-day chart on ASML to really get the full picture as to what is happening there. Schneider remains under pressure, which I think is fascinating as well, given that it is in the sort of the power AI story. Nestle bouncing a little bit as well. That safety trade back, Nova rolling over. There's some really interesting stories out there, kind of day 2 stories that are really worth digging into. Let's get the full picture. Let's figure out what is happening here. Joe Easton back with the details.
So one of those day 2 stories, Guy, is Siemens Energy. Now, remember, the company reported orders after the close of trading yesterday and beat on its cash flow and the revenue as well. So we're seeing that stock coming up almost 4% at the moment. But remember, it was down 20% yesterday and the biggest decline in more than a year. So we are only seeing a very small trimming of that massive drop that we saw yesterday. Of course, that was all tied to DeepSeek. So on a 2-day chart, we can see that it's really still down around 17% since yesterday's open. Massive drops for that one, but those orders helping today. The other one with the big numbers in Germany was SAP. Now, they have raised their revenue outlook. A lot of that related to AI as well. Also, cloud infrastructure seems pretty strong in terms of their numbers there. But perhaps already priced in, that stock's risen around 20% on a 3-month basis, so potentially already factored in some of the strength in their order flow. Then a hat-trick of German companies rising. We've got Sartorius. This is over in the medical tech space. It's lab tech equipment, a big beat on their orders coming out of them today, and that one up 15%. They've got a couple of stocks listed there, Sartorius and Stedham also gaining as well at the moment. Those shares rising 15%. That one quite surprising in terms of the jump on those. Then in terms of tariff exposure, remember we had comments from Trump after the market close in Europe yesterday talking about potentially lifting tariffs more than 2.5%. Still all very unclear and what that will be focused on, but there was comments on miners specifically, so we were expecting some weakness, and we are seeing some of those stocks coming down. Glencore, Rio weakening, and the other ones in the focus for tariffs, of course, cars, BMW a little bit weaker, Diageo holding up in the drink space today. Then in terms of rating changes, one of them declining in terms of the luxury space was Swatch. That one goes underweight at Morgan Stanley. We've got results coming out of Swatch next week, and Morgan Stanley says that the sales are likely to be weak, and also potentially they are seeing the impact of the rising Swiss franc on their earnings ahead of that report. So keep an eye on that one. And finally, Anglo-American, that one is downgraded over at Bernstein, which says the trade related to BHP is now off the table given the recent reports we've seen on BHP's interest finally cooling. So they go market perform on that one, and we're seeing Anglo coming down 1% on the London market this morning.
Thanks, Joe. Joe Easton with a briefing on the stocks that are moving this Tuesday morning, 12 minutes past 8. Coming up on the programme, we're keeping an eye on European chip stocks after the US tech sell-off and the threat of tariffs from President Trump. He name-checked a number of sectors, and semiconductors was one of those. We'll be discussing whether this is a turning point for AI. It's been a busy week in tech so far. We'll recap it all. This is Bloomberg.
The news hit the market. I mean, when you look at, today, our results, you see that 50% of the Q4 deals had AI embedded. It's purely consumption driven. So, customers see value, they adopt AI. So I'm actually very confident that today, and not only today, in the years to come, look at our outlook, accelerated total revenue growth for many years to come. We are very confident about our business, and one key driver is, of course, AI.
That's the SAP CEO Christian Klein speaking to this programme just during the last half hour, in fact. Let's stick with some of these technology themes because there's a lot to bring together today. AI is in focus after the sell-off in the United States, of course, after the apparent DeepSeek breakthrough. We talked about it a lot yesterday, moved markets in the States yesterday, and we're rebounding a little bit from some of that in some places here in Europe today. President Trump, though, has also been making news by announcing overnight a potential tariff on foreign chip imports. Let's bring all of this together. Robert Lee joins us from Bloomberg Intelligence. Lots to talk about DeepSeek and AI, but thinking then, Robert, about the tariff story and what we've heard from President Trump on that front. We often think more about US chip exports, I suppose, given Nvidia and the scale of it and the importance of it. But here's Trump talking about putting tariffs on chip imports. How big a threat is this?
Well, sorry about that. I had a volume issue a second ago. But obviously, theoretically, it's a threat. But I guess I'm not an economist. But ultimately, who pays the price of tariffs? And I think the answer is universally understood. It's the consumer. And also, for a policy of tariffs to work, there has to be a locally available substitute. So if you're importing a key component or a chip from China and you can't source an alternative locally, then really, your importing companies and ultimately your consumers will be paying the cost of that. So I think it's a policy that needs to be very carefully considered, given the US semiconductor industry is largely focused on design these days and not manufacture. So much of what the US consumers and US enterprise uses is actually physically made in Asia, of which China is a major manufacturing base, as we know.
But so's Taiwan. Do we think that Taiwan will be affected by this? Because obviously TSMC makes huge numbers of chips outside the United States in Taiwan.
Well, both of you are sat in London at the moment. Isn't the UK government worried about, Trump putting tariffs on its supposed closest ally? Trump's talking about tariffs on the Canadians as well. If he's going that far in his tariff policy, then tariff on Taiwanese imports is potentially a possibility. But again, if you're going to do that, where's the local supply of domestic chips? Outside Intel, Micron, and a few others, there is not a huge volume of US or chips fabricated in the US these days. That's the reality of the situation. There's no substitution.
Well, Robert, to that point, Nvidia, as Jensen Huang, very specifically, and we know that the stock, for example, has been hit by the export controls that you point out, very specifically said that this is a function of kind of some of the export control policy out of the United States. Put some numbers on it for us, though. We know that Nvidia spent a lot of money making one chip for the States, another chip for everyone else to kind of avoid some of those government regulations that you're referencing. But how much does that cost? And can someone who's not sitting on trillions of dollars of cash use the same strategy?
That's a very good question, and I guess some of this is not fully disclosed by Nvidia, and also it's a highly sensitive subject. But I guess one common theme in semiconductor world is design reuse. So obviously Nvidia may design one chip, and so they won't start from a blank piece of paper if they're selling an effectively cut down version. So I guess the incremental cost to the likes of Nvidia, there would be a cost, but it's unlikely to be overly significant. And as you've said, their free cash flow is tremendous, and as is their balance sheet at the moment. But it's the potential disruption that it would cause, and still China is a significant market for them. So if as a result of these export controls or whatever, access to China market and Chinese customers is going to cut off, that could cause, certainly some problems even to the likes of Nvidia.
Robert, we've heard a lot of views on DeepSeek over the last 24 hours. Some people really impressed by the technology, and some of those who are impressed by it are the ones who perhaps stand to lose the most. Over in the United States, the likes of OpenAI and Nvidia, at least publicly, are putting out very positive statements. What do you make of the way this is going down in the US tech sector?
Okay, I think as I probably said yesterday, actually, DeepSeek hasn't really been under the radar, and in fact, its details have been listed on US benchmarking websites for best part of 6 or 7 months or so. And I'm absolutely sure that OpenAI, Nvidia and the like have been aware of its presence for a considerable period of time. And also, theoretically, they would have factored the potential impact, whether that's a positive or a negative, of DeepSeek into their guidance and everything else. So whilst financial markets have reacted somewhat violently, maybe that's just a valuation correction. I think that it remains to be seen what the long-term impact or medium-term impact is on fundamentals. A lot of these companies are reporting near-term, but I think on balance, Nvidia is the only supplier in town, and I would expect in the near term anyway, the capex guidance and AI-related guidance for most of these big tech platforms to remain unchanged. One other thing very quickly on DeepSeek is it's an open source company. They've made a lot of the details of their models are actually available to the public. So without wanting to put too positive a spin on it, this could actually help increase the supply and help shift the industry move down to these low cost models. And ultimately, that could be a positive thing for the direction of travel. If it results in more cost-competitive, lower-cost models, could that help the proliferation of these AI applications within the broader market? Again, there's a question mark there, but that is one positive way things could evolve. Clearly, there are other alternative, less positive scenarios. So I'm not one to sit on the fence, but I think it genuinely is a little bit hard to call at the moment, and we'll have to see how things develop.
Certainly something we're going to be keeping a close eye on, and certainly something that the SAP CEO had also referenced. Robert Lee from Bloomberg Intelligence walking us through that story. We thank you so much. Let's talk a little bit about the other sector that's certainly moving quite a bit outside of technology, and that is the mining space. Commodities very much in focus after copper and aluminum were moved and shaken by Donald Trump planning to put some tariffs on those metals. You're already seeing some of the mining stocks under quite a bit of pressure. Let's bring in Bloomberg's Mark Burton, who leads our European metals and mining coverage right here in London. This feels like a fairly muted reaction. Is that fair?
It is fair, yeah. And I think it's partly down to the fact that for quite a while, traders and investors in the metals markets have been kind of taking Trump at his word when he said that he likes tariffs. He plans to impose tariffs in the metals markets specifically. We know that he likes tariffs on steel and aluminium in particular as a way of reshoring manufacturing activity and jobs. It's been a kind of a common refrain in his kind of path to the White House. There's also, though, a great degree of uncertainty as to the final kind of scale and scope of tariffs in these markets. And so the muted reaction, I think, is kind of partly down to the fact that a fair amount of tariff risk has been priced in already, but also a bit of inertia and uncertainty over how much further we need to go in
if this is about reshoring, the US is going to need the capacity to kind of compensate. If it's not coming in, you've got to build it yourself. You've got to make it yourself. You've got to smelt it yourself. Does the US, how quickly can the US get the capacity to compensate if tariffs are imposed? If the idea is to bring capacity onshore, where is it?
Well, it's been tariffs. Obviously, have been a kind of a growing tool in kind of US economic policy over the last several years, and there have been kind of efforts to reshore the production base. In copper, for instance, there are investments underway to increase production via scrap. And so the US has a kind of an import reliance on primary copper, but actually produces and exports quite a lot of scrap itself. So that's one area where if you build a secondary refiner to process that scrap internally, you can boost domestic production in fairly short order. Those investments have been kind of made, and that production should come through in a relatively short amount of time. That's another reason I think that there's a degree of kind of anxiety, uncertainty, inertia among the traders who are kind of thinking about the tactical opportunities that this presents. How much more will the US kind of need to import if ahead of tariffs if they're imposed, and what would the kind of final impact on the trade balance be once they are imposed, and we have this kind of this new steady state where perhaps there is a bit more production capacity.
Okay. Mark, great stuff. Thank you very much indeed. Mark Burton. Coming up, we're going to be kind of focusing once more on what is happening in the States. With $1 trillion wiped off the value of US tech stocks yesterday, is now the time to buy. We're going to be discussing that next with Cathie Wood, ARK Invest founder. That conversation is coming. This is Bloomberg. Morning, folks. 8:30 in London, 30 minutes into the equity market session. A bounce back of sorts, as you can see on the screen in front of you. It's not exactly a convincing full throttle rally that we're seeing emerge on the screens in front of us. This obviously comes in the context of what we saw yesterday, massive sell-off with US tech stocks. The apparent AI breakthrough by DeepSeek seeing almost $1 trillion wiped off the Nasdaq's 4 biggest companies. Nvidia alone yesterday saw $593 billion wiped off its market cap. That's the biggest fall for a single stock in US market history, though if you take a look at the top 10, Nvidia does account for a fair proportion of them, so that's probably just worth bearing in mind. We've got the perfect person to talk about all of this and what the implications are of yesterday's price action, of the DeepSeek news. Cathie Wood is joining us around the table, founder and CIO of ARK Invest. Good morning.
Good morning.
Very nice to see you in London.
Likewise, thank you.
What did you think of yesterday?
Well, as I've been saying, wow.
Yes.
But I think what it's telling us is the cost of innovation is collapsing, which it has been doing. I mean, the cost of AI training is dropping before this, 75% per year. The cost for inference, 85 to 90%. I think it throws the weight more towards inference chips from training chips. And so Nvidia is highly exalted, and deservedly so, in the training chip space. Inference is a lot more competitive.
OK. Do we fully understand the implications of that? Because the question that everybody's asking this morning is, do I buy the dip? So if we're seeing the landscape changing, is it too early to make that transition and understand what the implications of it are?
Yes, we've been studying the tech stack and where we think it's going. We're going to put out big ideas in, I think, a week.
Give us some hints.
Yes, so here's a hint. We do think there are share shifts taking place within the tech stack. We think platform as a service, so think Palantir, is going to gain significant share. And this news yesterday, I think, highlights that, reinforces that. We think infrastructure as a service is going to stabilize the share. Software as a service will come down a share. However, I've said all of that. All of them will be growing rapidly. It's just how rapid.
Okay. And Palantir, we should say, is one of your holdings, of course, a company you know very well, Cathie. So if inference is going to become cheaper, is this going to be a situation that drives more demand? We were talking about, is that where the positivity comes from? For the companies that don't train but do infer,
yes.
How positive is this going to be?
It's going to be extremely positive. So those using AI, whether for productivity or other applications, are going to benefit. We think the two most profound use cases right now, besides increasing productivity for everyone, autonomous mobility, so think cars, drones, and so forth, and interestingly, the healthcare space. We think the convergence of various sequencing technologies, AI, and CRISPR gene editing, that convergence is going to cure more and more diseases over time.
So these sound like huge positives for the businesses that are involved in that stream. What does it tell us about US tech overall? We had a conversation yesterday about whether this is some kind of end of US exceptionalism, and that might be in terms of stocks broadly, but in terms of the US tech sector, are we talking about that? Or is this just, the Sputnik moment that's been mentioned many times, a chance for the US now to catch up again?
Yes, I think competition is great for the U.S., and DeepSeek is competition, no doubt about it. I'm hearing all of the titans, tech titans, speak of it glowingly. I don't think we know everything about it yet. So, no, I think competition is good for the United States. Lowering costs is great for the world. The collapse in the cost of innovation should help all regions of the world. I will say that new productive forces, which was Xi Jinping's new phrase, I think 18 months ago, seems to be showing through right now. Common prosperity was the previous one, and I still think that's in effect. That was more about margins. This is about innovation. So we're looking more closely at China now.
I want to pick up on China in just a moment, but I want to go back to that point you made about cost of innovation collapsing specifically. That would almost lead to the fact that perhaps it brings down the barriers of entry for mid-cap tech firms or maybe people away from the hyperscalers. But you haven't seen that second level outside of the AI adopters really catch the same bid in the way you see Amazon or Microsoft or even Oracle catch up a little bit. What's the hiccup there if, as you say, the cost of innovation is collapsing? Why aren't some of these stocks reflecting that?
Well, I think there's a big debate going on. And if you look at the second, third, and fourth quarter of last year, you look at the mega caps and the rest of the stocks in the S&P 500, you'll see mega caps in the second and the fourth did very well. And the smaller cap stocks did very well, much better than the mega caps in the third quarter. I think there's a little bit of a tug of war evolving here. And if we're right, the most massive concentration in the market in history, worse than the Depression, is probably going to give way to a broader-based bull market. We're seeing that in our portfolios, and it really did start right around, actually, the day after the election. And I think one of the most important things is going to happen is regulations coming down. Even in AI, in the United States, their regulations started to intrude in a technology that is today where the internet was in the early 90s. We don't even know what we have yet. Yeah. We're as excited as back then, but now is not the time to regulate it heavily.
Well, I think you've got the president on your side when it comes to that in the States. I want to come back to kind of this idea of the hyperscalers here. You're famous for your beta strategy, especially when it comes to the tech space. I think it's fair to say that the highest beta right now is in some of these tech names, in Nvidia, in Microsoft, in Google. Just looking at some of the moves we've seen in the last 24 hours, not to mention the last 12 months or so. Why not increase your holdings for more exposure to the hyperscalers? Yeah, we do think, we do own Meta and Amazon in our flagship, and we own more of them in our other more specialized portfolios. And in Europe here, we have an AI and robotics fund, and we hold probably most of them because they are going to benefit from the declining cost in AI. And even Meta, who was really the open source leader. DeepSeek is open source. I think Meta is saying, wait a minute, what's going on here? And they're going to use some of the techniques, the algorithms that DeepSeek has used to improve their own platform. So we're not negative on them. We think that the neglect of the rest of the market has been extreme, and that is going to change. That the strongest bull market out there is a broad-based one. A market favoring 6 or 7 stocks alone is not a strong bull market. And so if we're right, the bull market will strengthen out and gain momentum, rewarding smaller cap stocks than we have seen thus far. You use Meta as a great example. Meta, before they went all in on AI, went all in on the metaverse, and there was a big pullback on some of that investment. Yes. Do you need to be sitting on billions or trillions of dollars in cash to excel in AI in the next 5 years? Well, I think DeepSeek just taught us that the answer is less than people thought. You don't need as much cash as we once thought. I don't know if the number is right, 6 million to train that model. That's unbelievable. It's a tenth or less. Now, many people don't believe that, but again, it fits in with the costs collapsing thesis. They were collapsing anyway. DeepSeek has just stepped it up a notch.
Cathie, you mentioned earlier that you're increasingly looking at China. I'm interested in what that looks like, but also how much you think that the US tech companies are going to engage with this, or US businesses will engage with this new technology, DeepSeek, coming as it does out of China, given everything we've heard about TikTok and where your data ends up. That might raise some flags for some people. You know, it's very interesting. We've been thinking about President Trump, or many people have been thinking that, oh, wow, this is very negative for China and U.S. Relationship with China. But there is another point in history that might be repeating to some extent here. It's called Nixon in China. Nixon did not trust China. He and everybody trusted Nixon because he did not trust China, and they knew he wouldn't lead us astray. I think the same thing is happening here with President Trump. And from a technology point of view, I think he likes the competition. And he actually did say, I believe yesterday, that, you know, this just shows that even in the U.S., regulations, especially that executive order on AI, which he rescinded, probably has held us back. And now, let's go.
Cathie, you talked a moment ago about the Great Depression and the concentration we saw going into the Great Depression and the number of single stocks. Do you think we get a smooth transition from that concentration to the broadening out of the market? That's not what the Great Depression taught us. It taught us that you get a collapse, and US consumer confidence and so many other things seem to be hinged on this stock market performance. Mm-hmm. Is it a smooth ride from concentration to diversification? How big a gap could there potentially be between one and the other?
Yes, if you look back at the Depression, I'm not going to get all of these numbers right. What you'll see is the massive concentration took place until 1932. Yeah. At which point the market started broadening out. And small or mid-cap stocks back then way outperformed large-cap stocks. And it makes sense. They had been absolutely destroyed during the Depression, which was binary. Is this company going to survive or not? With output down 30%, GDP down 30%. It is surprising to me that we got to an even greater point of concentration than the Great Depression. It tells you that in an underlying sense, there was a lot of fear in the market and that investors were piling into cash-rich companies that, oh, by the way, had, a leg up perhaps in this new thing called AI. Now I think it's just going to broaden out.
Okay.
Cathie, stick with us. We have plenty more to ask you, especially on that deregulation theme, and of course what this means for those risk assets. We're going to talk about volatility next, specifically in cryptocurrencies in the wake of the tech sell-off. Cathie isn't going anywhere. Don't worry about that. Yeah.
We will continue that conversation. Brief interlude to mention the banking sector, though. We have some news lines coming through from HSBC. They're saying they're going to be shuttering some of their investment banking units in Europe and the US. They will retain more focused M&A and equity capital markets capabilities in Asia and the Middle East, and will look to wind down those activities in Europe, the UK and the Americas. So a lot more to unpack when it comes to what that means for the broader HSBC business, for sure. We'll be back to Cathie shortly. This is Bloomberg.
Welcome back to the opening trade. We're about 45 minutes into today's session. Seeing green on the screen marginally, but green on the screen nonetheless. You are seeing the stock 600 higher by 0.3%. The other index is right on its heels. Underperformance over in France, though. Some of that is a luxury story that, of course, we're going to continue to keep our eye on. But I want to bring back in Cathie Wood, of course, this founder, CEO, and CIO of ARK Invest, especially in the context of the tech sell-off yesterday, because at the same time, we also saw Bitcoin seeing quite a bit of volatility. We're looking at a Bitcoin handle of about 103,000. Cathie, I want to bring you into this conversation. You've been a crypto bull for a very long time.
Yes.
You've also, prior to the break, talked a lot about deregulation under Donald Trump in the tech sector, but then also in the crypto sector as well. What has fundamentally changed since he's taken office when it comes to deregulation?
I think we will get significant clarity in terms of regulation. We will get legislation as well. I think many more policymakers in Washington understand that this was a single vote issue for many voters, especially young voters. And so this is becoming much more of a bipartisan issue. And of course, you have the executive branch also supporting it mightily, proposing that we include Bitcoin in Treasury reserves. So you've got, I think we're going to have support of all three branches of government are going to be supportive, which is a big change.
Well, it would be a big change. And I mean, are we really sure of that, I suppose, is the question, because Gary Gensler, the SEC, had a very different view of the risks and the retail investor protections that should be in place when it comes to crypto. There are surely a lot of people who still believe that's important.
Well, I think he didn't understand that this is the next big wave of the Internet. This is the layer of the Internet that developers did not build in the early 90s because no one thought anyone would buy or use financial services on the Internet. I remember back then, no one was going to give their credit card to the Internet, right? This is the next big wave, and it's a huge efficiency move for the financial services sector. So in terms of Bitcoin specifically, it is really the leader in a new asset class. And we have a paper out on that. You can see the low correlations, which do define a new asset class. And it is a global monetary system. It's a very big idea. My professor, mentor, friend, Art Laffer, when he collaborated with us on our Bitcoin paper in 2015, he said, "This is what I've been waiting for since the U.S. closed the gold window in 1971. So he has been energized by this new movement towards a rules-based global monetary system.
Do you think Trump's going to be on board with that? Like, the president has indicated he's quite a big fan of the US dollar, and it sounds like what you're suggesting is a replacement for the US dollar.
No, we actually think that that these two will coexist. And if anything, what we're seeing with the stablecoin movement, which is how people, is the on-ramp into decentralized financial services, they're all backed by Treasury securities, which de facto they're backed by the dollar. So we think that movement is gaining momentum here, especially now with the deregulation.
You say they're rules-based, but then we see more coins coming all the time. So they might be restricted
from
supply.
the president.
Yeah, from the president and his wife.
So
you
I
can...
said Bitcoin was rules-based.
Okay.
21 million units, and we're nearly at 20 million now. So that scarcity value will continue to support Bitcoin going forward.
So you're talking about the stable coin kind of being backed by these, basically by the federal government. Why not just use the digital dollar and develop the digital dollar as that same appeal?
So I live in Florida, and the governor of Florida, Governor DeSantis, has said he will never allow a central bank digital currency to be used in Florida. I think Texas has said the same thing. This is a states' rights issue, and it's all about privacy. Many people here in Europe don't think we care about privacy. On this one, on this score, we care about privacy. And this president very much supports that point of view.
Well, you're talking then, wading back into the idea of regulation and cryptocurrency. A viewer is also kind of chiming into this conversation. Cryptocurrency has rallied so much on that speculative ability and being unregulated. But if you're talking about these almost caveats to stable coins or caveats to Bitcoin or caveats to other tokens that may be traded, doesn't that kind of eliminate the fundamental appeal of what has moved it to 103,000?
So Bitcoin, I don't agree with that at all. I thought where you were going was all of these tokens being issued. We went through another period like this. It was 2017, and Bitcoin that year went from less than $1,000 to $20,000. That was the ICO boom, and most of those failed. So it's buyer beware. Be careful, and that is why we need some regulation here, because it's out of control, as I think you would say. Bitcoin's a completely different animal, though. Completely different.
Isn't Bitcoin just a correlated asset to tech? That's the lesson from yesterday.
No, it isn't. Actually, it's part of the tech movement.
The correlation on the numbers looks pretty convincing.
It's part of the tech movement. But if you look at Bitcoin, it has served as both a risk-on asset, so that's tech, yes, but also a risk-off asset. When we went through the regional bank crisis in the U.S. in the spring of 23, Bitcoin took off. Why? Because there's no counterparty risk in Bitcoin.
If big tech sells off, will crypto go down significantly?
The correlations are there is a correlation, but it is not as high as, small cap equities to large cap equities. The more institutions get involved, the more correlations will go up. But right now, if you look at the statistics, the correlations in terms of returns and risk among these assets, very different.
We'll let you get back to Florida and the better weather and the sunshine. It's great to see you, though, in London.
Thank you, guys.
Thank you very much indeed for stopping by to see us. Cathie
Thank
Wood.
you.
Great stuff. Thank you. The CEO and CIO of ARK Invest.
Now, if there's going to be a lot more talk of crypto, and we've certainly got that impression from the president, then is there going to be a lot more of that crypto money chasing luxury goods? Let's make the link to LVMH, shall we? Expected to report a subdued set of earnings later today, waiting for a crypto boom, perhaps. Let's talk to Bloomberg opinion columnist who covers luxury and consumer goods, Andrea Felstead, who is with us on set this morning. Andrea, so LVMH heading towards the earnings. We're thinking of crypto, but tell us the big picture story around LVMH. What are we looking for?
Well, we're looking to see if it's going to outperform in the same way that Richemont and even Burberry did. So far, all the luxury goods companies that have reported so far, Richemont, which owns Cartier, even Burberry, that's been really struggling, they've really beaten expectations with Richemont by some mile. So, my guess is LVMH will do the same.
In terms of what is driving it, is it America? Is there any turnaround that we're going to see anywhere else in the world? What are these numbers going to tell us about where LVMH goes next, not really about where it's been, but where it goes next?
I think it's all about the US. China isn't getting any worse, but it's not getting any better.
Right.
Whereas the US, since the election, since, Cathie just talked about Bitcoin, since, the stock markets have been sort of melting up until recently, US luxury is very correlated with those factors. And that seems to have driven demand in the US, whereas China, it's not really coming back yet.
Can we talk about the news of the last 24 hours when it comes to LVMH? That is the minority stake of Stella McCartney getting bought back. Walk us through that story.
It's really a tidying up by LVMH. We saw them sell Off-White. They're now selling their stake in Stella McCartney. This is really tidying up the portfolio. We've had big changes at LVMH, lots of management changes. Questions about succession. It's really just a tidying of the portfolio. The big issue would be is if there is any type of breakup of LVMH. We actually wrote a year ago that, you could break it up if you were to value the Louis Vuitton and Dior anywhere near Hermes. So LVMH is on about 25 times PE ratio. Hermes is on 55 times. So if you were to take like Louis Vuitton and Dior and value them anywhere near Hermes, at the time we worked out that you basically got the rest of LVMH for free.
Yeah.
Numbers might not be quite the same now given what's happened in the last year. Lots of speculation they could spin off wines and spirits. So what everyone is looking for is for LVMH to become much more of a pure luxury play. You've got wines and spirits, you've got the duty-free business, you've got beauty. Beauty's pretty good at the moment, pretty good hedge. But you've got all these things. Does it become more of a pure luxury?
He spent years building it up. Maybe the value's in tearing it down as well. Two-way trade. Andrea, we'll look forward to the numbers a little bit later on. They're coming just after the market close a little bit later on. Blooming opinions. Andrea Felsted. Let's get back to this HSBC story.
And there's a link there, isn't there? Because there's a lot of M&A in what you just described and a lot of fees for some bankiers. Really big story out of HSBC. We were talking to Cathie Wood when it broke, but this really interesting story. HSBC is winding down some of its investment banking operations in Europe, the UK and in the Americas, really retreating on the investment banking side into its core operations in Asia and the Middle East over coming months. So this is Europe's largest banking group, essentially withdrawing from providing equity capital markets and advisory services outside Asia and the Middle East.
So there's a big building just over there that's being kind of refurbished at the moment. It's where HSBC is ultimately going to go, out of Canary Wharf. And there's been this sort of chatter for ages. People I know, there aren't enough seats at desks in that space. Maybe we now have an answer to the question of the desk space problem at HSBC.
Yeah, an interesting one. The shares are down about, I think, 0.8% here. So certainly a story that's moved the markets. But we know, to your point, that there has been quite a bit of restructuring. I think the big question for the markets here is, do you still buy the dip? And you are seeing some marginal positivity in these broader indices, especially when you look at Europe. Outperformance in Germany coming off of those SAP results. Underperformance over in France. That does it for the opening trade. The Pulse is up next. This is Bloomberg.